Welcome back to the channel. As always, if you copy trading, you are an absolute moron and you deserve to lose all your money. And with that out of the way, we're going to speak today about a stock called INOD Data, ticker INOD, trading at just over $75. But as you can see, the company has had a bit of a run up, rising from the low single digits all the way till reaching almost $100 up until recently. And following a correction here where we've seen a lot of money coming out of AI names, and this is one of them, we see that the company has had a bit of a pullback. But I think now is a good time to enter this as a long. I'll explain why, because the company, as you can see, has been around for a really, really long time, and most of its history has been flat. So clearly it has underperformed the broader market. So what's going on? Why is it going up so much right now? Well, for decades, this was a very obscure outsourcing firm, and they made their money by helping publishers, insurers, and banks clean, tag, and organize data. That is a slow and low margin business that hovered about 70 to 80 million in annual revenues. Nothing exciting. But then, of course, as we know, the world changed. With the AI boom exploding, right? Big tech needed suddenly a lot of specialized services like this, specifically structured and high quality data to train and test large language models for AI. Every model, whether it comes from Google, Meta, Amazon, they need billions of labeled and verified examples to learn safely. And that work cannot be fully automated yet. Only a few companies worldwide can do it at scale, and this is one of them. But it was already built to handle complex and high volume data pipelines. So, of course, the turning point, as we know, is over here, 2023, 2024. That's around the time that some of the world's largest tech companies discovered about Innodata's capabilities and ramped spending fast. By the end of 2024, that one client that had grown to about 135 million of annualized revenue. So that's about half of Innodata's total revenue, right? And the total company revenue doubled to about 170 million in 2024, 96% growth, with gross margins near 45% and EBITDA margins over 23%. Unheard of for a company in their space. So in summary, they went from a sleepy data outsourcer to a core supplier to big tech AI development, which, as we know, is going to continue accelerating based on the ecosystem and the capabilities that are expected to keep growing exponentially. If we take a look back, you can see how the company about 10 years ago was making about 60 million in revenue and was fairly flat year on year up until that time where revenue is now just over $200 million. But it was only about 80 3 years ago. So that is phenomenal growth. Equally, as you see here, the gross profit margin has been increasing. The EBITDA margin has turned uh, high, excuse me, uh, double digit from negative, right? And net income as well has been increasing substantially. Now, debt, it's very low, and cash is also building up pretty fast. So with all those things, where is the company now? Well, at the moment, they serve 8 major technology companies, and they're guiding for a significant growth as well. So when we look at sales, expected to grow 45% this year and continue to grow in 2026. As for EPS, fairly flat next year, but increasing significantly. So sales for a market cap at just over 2 billion, very significant, and that's one of the reasons why I'm looking at this stock. Now, in terms of what's going to continue driving this growth, well, there is a factor here, a secular driver, that I think is going to lead the next phase of growth. The company has built a trust and safety automation platform, which uses AI to automate the process of testing and evaluating other AI models. When big tech trains an LLM, they need to check billions of outputs for bias, misinformation, and safety. Up until now, that meant that thousands of INOD data employees were doing this manually. And this platform is now performing much of that work automatically, flagging only the edge cases for human review. So think about that. In summary, you have much higher productivity with less of the cost. So each team can now process about 1.5 times more data without hiring more people. That means that 40 to 50% more revenue capacity come from the same contracts. And it also raises gross margin from 43% to up to 50% since automation replaces human labor. So the platform doesn't just save money, but it expands both revenue and profitability. And it turns InnoData from a body shop into a software-enabled data infrastructure company with real operating leverage. As a matter of fact, I do believe that this is one of the things that will make the narrative very compelling for the market. I do see this type of infrastructure, this type of operational leverage be highly coveted by bigger players. So I think they make them a prime acquisition target for bigger players. With a market cap of just over 2 billion, I see that as a potential factor. And happening in the next few months wouldn't be a surprise. We're now in the middle of October. M&A tends to be very, very active in the last few months of the year. So in terms of how the automation platform changes the economics of both and future clients, that's something important that I want to delve on. So the existing clients will result in increased revenue per client. So the same customers can now push through larger data sets and new categories of work. Management estimates that this can lift per customer revenue between 30 and 60% year on year, translating into about 50 to 60 million in incremental revenue by 2026. Again, considering the current revenue base of the company, that is significant in itself. It would also aid with onboarding new clients. So because the platform is modular, it can be deployed for new customers and it can be cut and sliced depending on their requirements. Management expects to roughly double its large client base from 8 to 15 large clients over the next 12 to 18 months. Each new big tech account starts around 5 to 10 million in annual spend and typically triples within a year once projects expand. That's another 40 to 60 million potential upside. Again, pretty significant when you look at revenues of this size. And then it provides as well higher throughput per person. So costs don't rise linearly with revenue. So you have very good economy of scale. With 40% revenue increase, you could drive more than 50% EPS growth. So EBITDA margins expand from 23 to near 30%. Again, pretty significant, and that would aid for sure in terms of the valuation. Now, I believe that that is the biggest force looking forward for this company. I see that as a game changer. I see them as becoming a critical part of this wider AI ecosystem. And like I said, potentially even a highly coveted acquisition target. But there are other things that reinforce the story. So the company has expressed a second major statement of work with the largest customer. That adds multiple new data programs that could reach 60 to 70 million in annualized revenue once ramped. This is already underway this quarter. However, we know how competitive the AI space is becoming, with different competitors trying to catch up with each other and throwing money um, to new projects in the AI space at very large amounts. So it wouldn't be unusual to see more statements like this coming from management in the coming months. They also expect to ramp up new big tech customers, so likely scaling that to 30 to 40 million next year if delivery proves strong. Together, these catalysts reinforce the same underlying transformation, scaling, diversifying, and automating the business model. So with all those things, I do believe that the company is expanding work with its biggest customer. They're adding new big tech clients. They're rolling out automation to cut costs, but also increasing their productivity. You put all those things together, and you get a very explosive upside. At the moment, as I mentioned before at the beginning of the video, it's had a bit of a pullback, but uh, it would be shocking to see how a good statement in the upcoming earnings call on the 6th of November and potentially some more announcements drive the stock even further. At present, price target stands at 78 with a high end of 110. So there's room for growth. Now, we could play this with options. That's likely the structure I will follow. But for now, I'm going to keep this on the watch list and see a more tactical entry point for me to get around. This moving average here would likely be a tool for me to decide on that. Hope you enjoyed the video. See you soon.